7:05. Thanks everyone for coming and joining. Welcome to South Asian Real Estate. We're going to be talking about how to find deals, raise money, buy real estate. Really, it's just helping people who have no idea what they're doing, get from point zero to investing and building up a nest egg of their own so they can retire early, or at least have something more dependable than a 401k. Today, we're going to talk about commercial real estate. I know we've been going on this beginner series for a long time, trying to help out new people and talk about, how to get started. But then there's a lot of people who've been interested in how do I get to the next level. So most of us know about apartment complexes. Not a lot of us know about commercial real estate. So I kind of want to bring on my friend Ryan Stenberg here to sort of talk about it with me. If you want to unmute real quick, Ryan.
Yep. Hey, everyone.
All right. Ryan Stenberg and my friend Abe are with West Egg Realty. I've known them for literally only a little more than a year. We all quit our W-2s at the same time. And in that time, they also acquired about 15 million in Nevada, just moving a lot of product, going through and finding deals left and right, basically utilizing tech and just being young and knowing how to work with the market. So they have a couple of horror stories that I've listened to, but now we're hoping to partner up and go on bigger projects in North Carolina, Texas. And I think Ryan has a lot to share in terms of, North Carolina, Texas, all the stuff that they were learning since they've been finding deals left and right. They're under contract for 15 million in Raleigh-Durham after a month, right?
Yeah, right now we're going to check them out tomorrow, about 15 million in contract right now.
Yeah, what my favorite part is? This is their first time visiting Raleigh-Durham. So that is the perk of going commercial real estate. Anything else, you want to share about, I guess, how commercial is going for you guys?
Yeah, happy to share. So Nelson, I didn't really know exactly what the agenda is. So I'm obviously kind of sitting out here on a park bench in Raleigh-Durham at an event. Yeah. But I'm super happy to share, why we kind of went into commercial real estate and away from multifamily. So a little background on myself. I used to work at Google up until about 6 or 7 months ago. My partner, Abe, that Nelson mentioned, worked at Amazon. We came from the same high school and some similar background, but we both left around 6 or 7 months ago to go full-time into real estate. And so we kind of built up enough traction that we could finally make that jump. And we started actually in the multifamily world, and because that's what we knew. And so what we found is a lot of people start in the single family home world because people have grown up in a single family home. And they understand who the buyer is on that side. And then they move to multifamily because they've also been a renter and there's enough comfortability there to understand it's a little bit bigger, same mechanics, but at a slightly larger scale. And a lot of people kind of stop there and they don't make the next, there's another jump that can be happened to the commercial world. And when I say commercial, I mean office, retail, industrial, and some other items, mobile home parks and self-storage and things like that. But a lot of people don't kind of make that jump because they've never been a commercial, a retail tenant or an office tenant, something like that. And so there's less understanding there than there would be in the multifamily space. So what we found is we kind of like to take, there's a big venture capitalist in Silicon Valley. His name's Peter Thiel, and he has a theory of, or one of his, I guess, most famous quotes is, "Competition is for losers." And we take it very seriously. And every asset we go after, every market we go after, and the way we go after it, we don't want to compete with anybody across the board. So when we try to generate deal flow, we're from the tech world. So we do a lot of A/B testing across the board, whether messaging, calling, mailing, dropping wine off on people's house, doorstep, knocking on their door. What's the most effective? We A/B test it all. We A/B tested every step of the way. And what we found is we kind of found this niche where in single family home space, you're competing with a ton of people for a small subset of the market. And as you move, towards multifamily and then towards the end of the spectrum in commercial, you are competing against a very small subset of people in demand. And you're maybe one of the few that are actually going direct to seller. And so we found a lot of success there, not because we necessarily believe that the future of retail is as bright on the whole as the future of multifamily. I wouldn't look at both of those asset classes and expect the same appreciation over the next 5 or 10 years. But because there's no competition in the retail space, you can get in on 50 cents on the dollar on buildings. And so there's other ways to make projects work that aren't just looking at the long-term appreciation of the asset, especially if you're going to flip it anyway, or get in and out quick. So that's what's kind of driven us towards commercial, and why we've been focusing a lot more of our time on the commercial assets recently. So we did about our first half, we did about 10 million and maybe more like 8 million in multifamily in Reno, and then followed it up with about 10 million in commercial. And now all 15 million we're in contract out here in Raleigh with, they're all commercial assets. And it's that same story. We can get in at a really low price because there's no competition.
What about those 5 duplexes? You guys dropped that one?
We also, that's another interesting thing. So yeah, we're waiting on the seller to get back to us. But in the multifamily world, you end up playing with a lot of smaller, mom and pops and whatnot. And in the commercial world, it's a lot more business people. And so we end up kind of putting in a lot of time and energy in the single family home world or the multifamily world to convince, get someone to sell, get them on board, walk them through the process and the steps. And in the commercial world, we skip a lot of that. It's just, here's what I can pay, yes or no. And it's as simple as that.
They're also being humble. I was looking at their deal flow. They had about 400 leads out in Raleigh, Durham, of people who are like, oh yeah, I'll entertain an offer. And then, it's very significant. I'm looking through their, the deal flow, and just, I barely can keep up with trying to do the underwriting and, looking at their numbers. So, and I agree. Another part of it that Ryan hasn't mentioned too is like, I think when you go commercial, it's a lot easier to partner with people when you go bigger. You don't have to, be stuck competing for the same sort of deals and numbers, especially in like single family. Oftentimes you're kind of stuck, hoping people don't figure out who your agent is that you like, that finds you deals. You don't want them to figure out your contractor. Oftentimes, you're in this really competitive mindset because it's like a single deal that, there's not much to share. Whereas in the commercial side, there has to be this abundance mindset because these deals are so big, right? And they found like a $10 million factory. Like there's a lot to go around when, it's a $10 million factory and the value of it should be closer to say 12, 13 million, right? So I think commercial, honestly, is, that's one of the biggest perks of it. It just feels a lot more like a team sport instead of being stuck trying to fight for small slivers of pies. Even though the overall market is kind of bigger. But aside from that, Ryan, do you have any other tips in terms of deal finding when it comes to the commercial side and things that you like and when you are, say, negotiating that you can't really do in the residential side?
Yeah, definitely. So we find that the sellers are very different when you look at single family to multifamily to commercial. In the single family world, it's a lot of follow-up. It's a lot of kind of buttering people up and, winning trust and things like that. And in the commercial world, there's an element of that because there is still a human on the other side. But as I said, they're a lot more business minded. A lot of these are business owners, multimillionaires. And so you can be a lot more straightforward. In fact, they actually appreciate it a lot of the time when you're more straightforward. So when you come up and you ask, hi, my name's Ryan. This is what I do. This is what I've purchased. I'm interested in your property. Is there a price you'd let it go for? That can be your opener. You can just come straight in with that. And most of your responses are just the number they're willing to sell for. So you can skip a lot of the, call it foreplay or whatever you want to, however you want to phrase it. You can skip a lot of those steps and it actually saves you a ton of time and a ton of energy because you're dealing with people who are also business minded. And so you just jump right to the numbers and you go at it like that. In fact, sometimes it can harm you to be, patter around too much and be not direct. So we like that a lot just because it streamlines the process for us. We can get right into the meat of the conversation immediately. And so that's one of the biggest differences we've found with commercial versus say single family homes or something like that. And when it comes to the deal flow on commercial and multifamily, honestly, the same types of strategies work, I think, pretty well. A lot of people say there's kind of not a stigma, preconceived notion that you cannot get commercial properties direct to seller. You go through brokers. That's the way it's always been done, and it's the way that it's going to continue to be done. And 100% that is not true. I can prove it 10 times over that you can go direct to seller with commercial. And if anyone's phrasing it that way, it's not true. I think there's a lot of in the commercial world kind of an institutional network that likes to toss around properties to each other, and it feels a little bit exclusive, and doesn't it won't be that way for long.
Yeah,
and it's not that way already.
Yeah, I changed my mind a lot too, especially chatting with Ryan and Abe over the last few months. I'm used to luckily having a partner who's much older and has like a decade of 2 decades of experience in commercial real estate, and so he has this relationship with all the major brokers in town, which doesn't really happen, for somebody who's in their 20s trying to break in. It feels like there's a barrier to entry that you can't enter unless commercial broker. And then in the last few months, I've been seeing them pretty much find deals left and right, going straight to the seller and just cutting out 4 or 5% of a $20 million project. I'm like, yeah, that sounds pretty nice. So I've changed my mind, instead of just going straight to brokers, which kind of where we source most of the deals from, that you can oftentimes just reach out directly to the owner and figure out yourself. So that's always something I learned from Ryan and Abe. They're also at a conference. I don't want to hold them off for too much longer. Anyone have questions? I'm going to open up for 3 to 4 minutes. I have one from Vince here. Yeah, debutante. He asked, how do you choose to target your sellers? Are there indicators for stressed sellers on the commercial side? You're going to love this one.
Yeah, we get this question a lot, which is, what lists do you use? Do you go and look at pre-foreclosed? Do you look at people whose mortgages are, almost paid off, or things like that? And the answer we have is we don't filter anything. So we take the entire, I really like Raleigh Durham, right? We grab the entire MSA for Raleigh and the entire MSA for Durham, every single property in there for multifamily and commercial, and we put it in the top of the funnel. And then we do our direct to seller marketing and campaigning down that funnel for every property. And one of the reasons we can do that for commercial is we're going straight to the important question, which is, what's your price? And when people come back with their price, that tells us where the hot leads are. We don't care about distress, or if someone, a property's falling apart. We don't care if, it's been neglected by the owner or whatnot. We just care that it's a cheap price per square foot, and that's where we're entering at. And so we can just kind of filter on that end.
While you asked, how do you know that you'll get a tenant, especially for, say, warehouses? Like with residential, everyone needs the same place to live, but how do you get confident that you can fill out, a triple net space?
Yeah, this is a great question. This is the biggest risk of commercial real estate, and it's where everyone kind of probably has the biggest fear is, what if I have a vacant building for a year, or something along those lines? So I would say 2 things here. One is that the commercial world is much more volatile, and it follows the economy much more heavily than, say, multifamily. So if there was an economic downturn, you wouldn't see 20% of the demand for multifamily disappear tomorrow, because you wouldn't see 20% of the population just disappear tomorrow out of the US. But if the economy went south, you could see rents drop across the US significantly. The same as the stock market drops, significantly when there's an economic downturn. So you are more volatile because businesses can just close up. When they no longer can operate, they can close up. So I do want to say that is one of the important nuances of commercial real estate, where it differs from residential and from multifamily. Now, that said, a lot of these businesses are extremely strong. They've weathered many economic ups and downs and cycles. And so there's a huge distinction between the type of tenant you get, the type of lease they sign, and who the person is that's backing that lease. And so when you're looking at a building and it has a McDonald's in it, that's very different than it has a local, mom and pop restaurant, something like that. So what we like to do is we don't like to take any risk when we close properties. So the way we view real estate is that by the day you close, you've already have a slam dunk project and you've already won. There's no risk left in the deal. And what I mean by that is, let's say we closed an office building about a month ago in Reno, Nevada. It was a 1 cap, and it was 65% vacant in the middle of COVID. And it doesn't matter because the price per square foot was $75 a square foot, and office building trades at $200 a square foot. And while we were in escrow, we asked all around Reno. We posted on LoopNet to bring in listings for rental listings. We call up local businesses, and we're searching for that tenant. And when we found a tenant, they master leased all the empty space. So the day we close, we have a tenant that signed a lease. They've taken the building. The building's no longer worth $75 a foot. You can go find it. We're listing it right now at double what we purchased for. It's been a month, and we haven't actually finished the rehab or placing the tenant, but the lease is in place. And so eventually when they fill up the entire building and they're paying the full rent, it'll be not quite 3x the purchase price of that building. So we purchased at 1.7. We'll probably exit around the 4 to 4.5 range, and it'll be a few month project. We try to mitigate all that risk in escrow by placing tenants in escrow. And you can get to the end of due diligence and realize I have no traction on this. I totally overestimated market rent. I thought it was $1 a square foot, and nobody's biting at $1 a square foot. In fact, nobody's biting at 80 cents a square foot. and you let go of the property. You say like, I didn't understand this deal. I'm gonna let it go. You move to the next one. We're in one contract on one now that we're listing on market while we're in escrow. And if we're getting blown up on our LoopNet listing at $14 a square foot, then we're confident to close if that's what we're underwriting at, because people are just, messaging us like crazy at $14 a square foot. In fact, we might try higher. We might close without the tenant because we're going to aim to get 16. And so we're going to take it back to, the list, but we want that confidence, and we need to guarantee that confidence by basically testing our assumptions while we're in escrow.
And then he followed up the question, can you even do that prior to escrow? Would that give you more time, thus lowering the risk even further, kind of like pre-selling? I think you can talk about an example that you guys are going through right now, right? With the Ashley Home Furniture.
Yeah, you can. So definitely you can do this before selling. You can't necessarily list on LoopNet or put up posters or things like that without the seller agreeing to it, because it's their building. You also probably wouldn't be able to get in there and take the right pictures and whatnot. So usually when we enter escrow, we'll ask for the right to market the building online or in person. And then we'll get in there and we will 3D Matterport the whole thing, take drone shots and photos, and then we'll publish like a pretty solid listing right off the bat. So usually we're doing the bulk of it in escrow, but when it comes to the other stuff, we're pulling data from CompStat, CoStar. What's the other one? Blanking right now. But we'll go on LoopNet and pull all the listings off there. So we'll have a VA that will usually like go through this and scrape all this data out, and then we'll call the local businesses around there. And usually my script will be something like, "Hey, I'm buying a building in the nearby area. The seller is telling me like market rent here is like X, but I'm not sure if I'm getting scammed or not. I was wondering if you would tell me what rent you're paying at your building, since it's a similar building." And a lot of times I'll get the answer there. So we'll collect data in like these various fashions. We'll start with the easy ones, and hopefully that's enough data. But if it's not, then we have to go through these more tedious and like strenuous ones, like calling businesses. So yeah, we just don't like to leave any doubt on the table.
Yeah, so risk is actually a lot lower than people think. You often have a lot of lead time, and you're not at risk depending on how distressed the seller is, because they're often going to give up a lot more, especially since people think all these commercial investors are smarter and more sophisticated. Oftentimes there's still mom and pops who are in a bit of a bind and willing to give a lot more as a result. Yeah. All right. This 7:23. I don't want to hold you any longer. Do you still want to keep answering questions? It's up to you.
Yeah, if there's another question or two I can answer. I don't really have a time limit. They're gonna be here all night.
Oh, okay. Question: is wholesaling and commercial the same, either assignment or double close? From Vince.
Yeah, there's not much difference. You can wholesale. I will say it's harder to wholesale in the commercial world when you're first getting in, because the buyer pool is way smaller. So in the single family home world, for example, you might put something in contract. You might know that, hey, this is 20K under market, and you go to a bunch of Facebook groups and you put your deal in those Facebook groups because they're wholesaling Facebook groups, right? In the commercial world, the reason we started syndicating is actually because the first deal we put in our contract, we were intending to wholesale and we failed to wholesale it. And we're like, well, this is a good deal. Let's just syndicate it instead. So we raised the money and syndicated that project. So that was the first time. And it's because the buyer pool isn't that large. And so you don't just go onto a Facebook group or go blast out to some network. If you don't have any connections in the commercial world, you might not be able to find someone. So it is the same in terms of mechanisms, but I would say that it's at the beginning, at least, harder to build that network unless you're already very well plugged into the commercial world. Maybe you worked at one of the big firms or something like that, and you know a lot of buyers.
Nice. Okay. Another question. How diversified are your assets? What's your perspective on the next 5 to 10 years, from Eugene?
Yeah, we have a few multifamily buildings. We have a motel. We have one motel, one office, one retail, one like light industrial, and we're in contract right now on about $7.5 million of retail and $7.5 million of industrial. So we're pretty diversified across asset classes. Like we haven't done self-storage and we haven't done mobile home parks, but we've touched on most everything else. And in fact, we might enter contract on a big single family home portfolio soon, for about 40 single family homes. So we're not scared to go into a new asset class, and we generally do like to diversify, but we do have favorites. So if you're asking about, the longevity of each of these different assets over the next 5 to 10 years, our preference leans heavily towards all other things equal, and we're buying at, the same discount. Multifamily and industrial, I think, are going to see I'm betting on the most for the appreciation over the next 5 to 10 years. And that's just because the macroeconomic trends for those two assets, with I guess the underbuilt supply in almost every every city out there for multifamily, and a huge housing crisis in most of these cities, as well as the migration from one city to another. That transition as people move from one city to another puts certain cities under the hot seat, under a huge amount of pressure to build more, and they can't build fast enough. So I like multifamily in a few different, a lot of the cities out there actually right now, a lot of the Sun Belt area. And then I like industrial because industrial, I mean, we've seen there's been an e-commerce trend for the last 10 to 15 years that's been growing very steadily until last year when it just, 3 or 4x or what it had done every other year. And so it just accelerated that trend. And we were already behind on industrial builds, which is why you'll see 5%, 6% vacancies in most cities, even pre-COVID. And now we're just further behind on supply being built in industrial because of COVID. So those two assets, all other things equal, I would choose those. But I will say that you can make any asset class work if you get in at the right price. So we don't buy retail at 15% off, whereas we might consider industrial at 15% off. If I'm buying retail, we're buying at 40, 50, whatever percent off. We want to get huge discounts because we need that margin baked in for two reasons. One, we need to de-risk the project. Two, that's where you make your big value add jump anyway. So it works both ways. Your safety and your margin are the same thing when you get in low at a discount.
Right. And then, you're picking up 8 cap properties out in, hot markets like Raleigh, Durham. So it makes it a lot better because your land's going to be worth more and hopefully carry you, even if it screws up. But that's definitely part of it. All right. I think that is it for, one more question. For leases, do you need a seasoning period before you could refinance out your loans on commercial properties?
So the standard answer, or the main answer is yes. You generally have like a seasoning period. I think that was the word you said. I didn't quite hear, but you generally have a seasoning period where you'll wait for the leases and make sure the tenant is going to stick around, that they're paying their rent, that your expenses are reasonable for this new tenant. And then you can a bank or whoever it is can assess the NOI of the property, looking back on the last 6 months or a year, depending on the bank. One thing I want to say is, like, when I got into real estate, I hear, I listen to like Bigger Pockets and things like different meetups and forums and whatnot. And I hear a lot of people talk about the lending world as if it's kind of like, this is the way it is. And the deeper that I get into real estate, the more I realize that the rules are all fungible for banks. And I don't even want to use the word banks there because I just want to say lenders, actually. So if you work with the right people in the loan world, if you work with the right debt structures, whether it's local banks or bridge lenders or hard money lenders or anything else, like, all of these rules are fixable. So if you're if you have a great property in contract and the one thing that's breaking the deal is you can't find someone who will give you less than 1 year seasoning period, I guarantee someone out there will do that for you. So lenders are all, they're flexible, and you got to find the right ones.
All right, that's it for questions. I'm going to call it there so you guys have time to go back to your event. Thanks for your time, Ryan. All right, he runs a group called Open Source Real Estate. If you guys want to follow him, in his group, he's also in SARE, but Open Source Real Estate is probably one of the best ways to reach him. Otherwise, just reach out to him directly for Ryan Stenberg. He's also, I got dog noises in the back. He's also crazy, wakes up at 6 a.m. every morning. We spent a room together when we were at the GoBundance event. So Ryan is probably one of the most inspiring people that I know. And if you're looking to get motivated in any way and you get stuck on a problem, he's the one guy I know for sure that's like, oh, what are you talking about? We'll just do it this other way. So yeah, that's it for Ryan. Thank you. We have feel free to take some time off.
Thanks for having me. See you guys.
Okay, now that Ryan's done, I'm gonna move the dog. I want to move the dog. I'm gonna move the dog. And it's dealt with. Okay, so that was Ryan. So in the meantime, we're gonna have Jason jump on with us later and talk about development. I skipped over someone's question about land development because I wanted to save that for Jason when he came on. In the meantime, I wanted to share this new resource, kind of new resource. It's really an old resource. All right, this is the Subtle Real Estate wiki Notion. I've updated a little bit so it's easier to read and you guys can break it down, because you're not gonna be able to learn everything about commercial real estate in one go. So what I'm gonna try to do is put it on the website, settlere.com, and then there's gonna be a link for our Wikipedia, more or less. I would love to have people contribute to it and fill it out. I've been getting started. You know, you can see here, it's like, here's some of the basics when it comes to investing, a few step-by-step processes. If you're not sure what to do, I'm also building out the non-residential commercial real estate portion, right? Talking about warehouses, people who, you know, have advised me on different projects and how to value things. A lot of this is still under construction, but the residential side should be more or less close to being finished. And so this side of the documents are generally somewhat fleshed out, and it'll get you about 80% of the way you need to get to there. Everything else on the commercial side is a lot more complex. You know, I'll try to break down terms and information as best I can, but it's very difficult to just do that without going really in depth. Like, for example, it's still under construction. For example, on the financing side, residential loans are actually very simple. Anyone can pretty much explain them to you, right? Because there's a box that you fit into and everyone fits into the same box. You just got to check to make sure your personal income meets the requirement and your debt to income ratio meets the requirement, and that you don't have like 10 of these conventional loans. Commercial loans put you in another category. There's so much to learn on the commercial side that it's very difficult to explain, which is why, fun fact, if you ever ask a commercial lender, hey, what rate am I going to get without having a project ready, they will get angry at you for wasting their time. So if you want to sort of get an idea, first thing you have to learn is your project stabilized versus unstabilized? You know, is it like a value add project, right? A stabilized project is going to change depending on multifamily versus a commercial triple net. So say you have a multifamily project, a stabilized asset is something that has at least 85% physical occupancy, meaning if you have 100 rooms, you better have 85 tenants or more. And then 70% economic occupancy. What that means is sometimes in order to fill up 85 rooms, people will give free rent for the first month to put people in it. So lenders have a new rule to make sure that you aren't cheating them when you're trying to get that stabilized requirement. So in order to be stabilized, you need to have this 85%, filled out for, I believe, 6 months. I'm not sure if they change these regulations all the time to adjust. For example, when COVID happened, they extended the interest payment reserve for a while. And so I don't exactly remember the exact numbers for it, but same thing in commercial triple net. If your property is vacant, that's a value add. If your property is ending soon and it doesn't have a strong corporate guarantee, like a mom and pop are putting their own personal money down for it, that's a risk. That's not stabilized. And so then you're going to want to know the difference between things like recourse, non-recourse, right? And then there's prepayment penalties associated with the loans. And then, depending on your stabilized status, you'll either get a bridge or agency loan. And there's so many terms involved in this, and it's just the financing part, right? So it's very difficult to go through and explain. So we're going to do a series on these commercial properties, one of which is actually going to be explained by, oh yeah, he's here. So, I mean, the guest is here early. But do you want to speak up, Jack, or are you comfortable being in the back? You're on mute still, I think.
You're talking to me?
Yeah. Jack is one of our future guests. He won't be here for another 2 months, but he's actually commercial triple net in the Bay. And so actually, fun question for you. Why did you transition to commercial real estate instead of doing residential?
Why? Okay, so actually I started out doing like duplexes, multifamily a little bit. And then I went through a horrible experience, a really horrible experience. And so then I was like, I'm never doing multifamily ever again. And then I got into triple net and commercial retail because I actually started in the restaurant industry. I opened 10 casual dining restaurants. I own a boba chain. So I developed a lot of restaurants. So I know a lot of locations throughout Northern California, in California itself. So I know like what to look for locations, demographics. I'm more like a value add guy. But yeah, so then I bought my first location because I bought it with the SBA, loan. And then the value went up, and I was like, "Wait, you can make money in commercial real estate." I bought it at 2011, 2012 at the very bottom, and it was seller financing that time when I bought it, right? And I bought it like a 2 cap, 3 cap, and then I put my own restaurant on it, and then now I realized you can make money in this, and I actually I opened a couple of restaurants, and I met some really good landlords. I met a guy named Don Tapman. He I don't know if you guys know Santana Row, but he owns a lot of property around Santana Row, right? And then he taught me the ropes. He was young. He's like, that time when I met him, he was like 35. He was super young, good looking. And I was like, how the hell do you have so much money? And yeah, then I went to lunch with him, and then he told me like, you can make a lot in commercial real estate. And he was a syndicator. I was like, oh. And then I was like, I really decided I'm just gonna put all my money and start focusing on commercial retail, multi-tenant, triple net, but mostly value add, because that's what he did. And I saw that you can make money with value add, but you have to take calculated gambles. Because in commercial real estate, let's say you look at 100 properties, only 1 or 2 of them are actually good. A lot of them are not good property, trash, really high risk properties. So if you're very selective and you mitigate your risk, you could buy value add and make a lot of money. And a lot of people, they don't want to do it because they think it's risky. They just want the 6 cap or 6.5 cap properties and just sit there, But then when you buy that 6 cap, 6.5 cap, and it goes vacant, you're screwed. So I don't look at cap rate when I buy properties. Cap rate's the last thing I look at. I'll buy something at 3, 4 cap. I look at the lease, I look at the location, and I look at the city it's in, and if it's leasable. So that's the first thing that's the last thing I look at is cap rate. The first thing I look at is the tenant. I don't care if it's like a Mexican restaurant, a taqueria, but if it's like in a hard corner in a good city with good demographics, I like that. I look at lease if it's at or below market. I never buy anything above market. I never touch. If I see a Starbucks, I never touch it. It's at or below market, and that's where you get the value add, long term. But anyways, enough about me. I'll talk about that in 2 months.
Yeah, I caught Jack off guard, but we'll hear us talking a more in-depth version when he doesn't have a baby to deal with in about a month. Months.
Sorry, I didn't know I had my video on.
No worries, it's fine. Okay, so we have our other guests here that I wanted to bring on the chat about commercial. Jason Shao, you ready on the mic?
Hey, how's it going, everybody? Can you guys hear me okay?
Yes, we can. So Jason has a pretty extensive experience himself. He has, was it 50 million under management, if I remember correctly. He's a developer out in LA. He buys, he is syndicating stuff. I saw something I remember a while back, but it might not have gone through, but he's going to have other stuff in the future as well. So Jason is somebody who also did the transition from residential to commercial. And then he went eventually to food halls, which is technically residential, but you now have 20, commercial tenants. When did you decide, I guess, going from the residential space into this commercial triple net? How did you break into it?
Yeah, I'm not really the usual case. Like a lot of our transitions or pivots happen by necessity or because my dad had an idea and we go figure it out. So food hall is it's commercial. It's essentially a multi-tenant restaurant kind of product. We have 11 tenants in there. And our portfolio has actually been shrinking because we've been selling a lot of stuff as well. But yeah, I mean, this one, it just kind of came about. That's how we got into the commercial world. That it was a brick building that Wonder Bread used to own, just totally vacant. They went bankrupt, but kind of like what Jack said, you know, we like the city. That's good, medium, medium income. It's at a very good corner, high traffic. Also, there's kind of in LA when the freeways are backed up, the secondary freeway or local road people use is this one, and it's also very easy to get on and off the two freeway intersections. So that was a big driver for us into picking up this project. And kind of like what he said too is, you know, there is a lot in real estate overall, or commercial real estate, but you know, this is what I preach to people is keep it simple. It's a math question. You want to buy something under market value and you want to sell it for more than you bought and put into it, and that's the value add component. But definitely a lot easier said than done. But yeah, I mean, I'm happy to answer any questions, or if there's anything specific you guys want to talk about.
I have a question that I was saving from when Ryan was answering questions earlier. When you're looking for commercial deals, what factors would you bring on board when doing a ground up development? Since I know you've done it already. When you start the land purchase, I mean, obviously zoning is important, but are there any particular factors that you look into on top of that?
Yeah, I mean, commercial real estate, I think it's just a lot more involved than buying a condo or apartment, duplex or something like that. I think there's just a lot more brain damage in the due diligence phase. Like you said, zoning, regardless if we're doing ground up or not, we're going to be looking at zoning to see if there are ways we can reimagine or revision, picture this property in a different way, or we can reposition it or add certain things to it. And again, the adage, right? It's all about location that we just talked about. And I think we already talked about this too. Like, definitely read the leases, not just, I mean, especially if you're in a single tenant property, there are a lot of details in the leases in terms of who's paying for what, or different triggers, escalation on the rent, and different option periods. And you know, it's a little bit less it's not as easy as residential, assuming you're buying in a normal place. Like, the vacancy factor really could kill your cash flow. So you have to vet your tenants, looking at them very closely. Like, there were a lot of interest where there's somebody like, this is their first business, and we just had to flat out tell them, sorry, like, you don't even have $10,000 in the bank. Like, we don't even think you can afford to buy furniture, so we're not signing, even though your food looks great and delicious.
Yeah, and so there's a few things involved with commercial triple net, especially like one, gauging, you know, the quality of your tenant, because that is kind of the most important thing. Ryan actually broke it down for me a while back too. Every sort of real estate deal has three parts to it. There's your land, there's your tenant, and then there's the actual building. And so you want to mitigate the risks in all three parts of it. And when it comes to commercial triple net, most of the time your biggest risk is with this tenant. And so the easiest way to do that is, you know, with those mom and pop shops, a lot of the time, unless they have, you know, years of experience and a strong cash balance, you know, ideally you can do a multinational triple net tenant. So cap rates, for example, we might be buying something at an 8% cap rate. And then when you replace that tenant who is a local grocery chain with, say, Amazon, your valuation immediately shoots up. You know, it could double in value for the same amount of income that it produces. And so there's a lot more, you know, brain damage associated with it, because there's more factors to consider. Whereas a lot of times residential, just well, you put somebody in it and you have 1,200 data sources to pick from, because everyone wants to do multifamily and residential, because it's the easiest one to do, since there's so many guides and examples that people are basing this information off of. And oftentimes the brain damage is often associated with the fact that you're working in a dark room and you're kind of building the bridge as you're falling down, for example. And so you often don't know perfect information or as much information as you would if you were on, say, doing residential multifamily. Like I could go on apartments.com pretty easily today and look up what rent rate should be at like within a mile of, that location. Whereas in order to figure out lease rates, I have to pay $850 a month to CoStar, which is a website that like aggregates data for commercial information. And then once I pay the $850, sometimes that data is imperfect, because what CoStar does is they hire a bunch of cold callers to follow up with agents and hope that the agent doesn't lie to them about the correct price, which is what we've been finding out while we're using CoStar since. So the data is now.
Yeah, sorry, Nelson. I want one more thing real quick to that too. That lease rate, there's again, it does get complicated in commercial term, because that number could be gross, it could be net usable, and it could, whether they include TI or tenant improvement or not, it could dramatically change things.
Yeah. And so, no, that definitely is right. Yeah, your tenant will determine your cap rate, building quality, that will determine your cap rate, but it's, yeah, there's less data to work off of. And I think that's the hard part for a lot of people. But yeah, so that kind of concludes most of what I wanted to bring on. Is just people talking about their experiences and why they want to transition from multifamily residential to commercial. I'm going to open up the floodgates questions so that you guys can kind of just hop on and talk about anything that's on your mind in terms of questions.
I've got one for Jack, actually. So at first, Jack mentioned that he looks for properties where the commercial leases are paying below market rent, and you're not looking at the cap rate. So what if there is like a 10-year lease or something that's left? Would you still consider it and just wait it out? Or what do you do in those situations?
I would. If 10 years is a little bit long, but if there's a lot of upside to it, I would. I bought maybe 13 years ago. 13 years, I bought, maybe 9 years ago, 10 years ago, I bought Dairy Queen. It was 3,200 square feet drive-through. It's 3,200 square feet. That's pretty big. And they were paying $2,500 a month in rent. That is like 75, 80 cents a square foot. All right. I bought it at like a 3 cap, right? Knowing that if I wait out 13 years and it's a drive-through in Sacramento, I would able to get maybe a Dutch Brothers, a Chick-fil-A ground lease, or even if it's 3,200 square feet, I might even get like a Jack in the Box in it. And even though I paid a 3 cap for it, I might be able to sell it for a 5 cap, and the tenant probably won't pay me 75 cents a square foot. They might pay me $4 or $5 if I give them good TI, So there's a lot of upside to it. All right. So if you have money to hold, then I would do it. I would buy at a lower cap rate, knowing that it's a good location. Good location, you'll always find a tenant. Like every city, right? There's always like a main retail corridor, and that's where you always want to be. And don't be on like a C location, and even you buy at a 6 cap, if it goes vacant, you're screwed. You always got to think of an exit strategy, especially COVID. What happened with COVID? A lot of restaurants start struggling. Luckily, the PPP and all these grants help, these restaurants stay alive. But, if all these restaurants close and you bought it at your 6 cap or 5.5 cap, but it wasn't a prime location, guess what? You're screwed, And it's really hard to find a tenant in those B or C locations compared to A. So as long as it's the A location, I don't care about the cap rate so much, because I know you always get a tenant. And if the current tenant leaves, there's a good chance you can get a national brand into it. So that's what I see.
Yeah. One thing I've been told a lot too when investing in commercials, don't look at what the current rent is, look at what the future rent is. So sometimes you might have a tenant that is also the person who owns the property, and then they charge themselves a higher rent, or just for some reason they had a higher rent tenant in there. And so the moment they're going to move out, that market rent is a lot lower. And so you're going to end up struggling to find somebody paying the amount. And,
yeah. like what I see is a lot of Starbucks. A lot of people say, "Oh, it's a Starbucks," you gotta buy it. But there's a Starbucks literally every block, right? And they move like crazy, and they always pay really high rent on your initial term, and then they'll go back and they'll bang you for the next option. Is like, you want me to stay? You have to give me better rent, So that's why it's risky. Always looking at just the cap rate. You shouldn't always look at the cap rate. You should always look at the brand and the location.
Yeah, real quick, if I may, just to tie back to what, I'm glad Nelson brought it up earlier, the risk factor. Like, if you're hung up on the cap rate, you need to let that shit go, seriously. Like, it's just a barometer of what the market's perceived risk for that property or the tenant. Starbucks, AAA trade for a 3.5 cap for a reason, is because they're just almost risk-free, like they're gonna be there. But I think ultimately, if you want to get into commercial real estate or just residential as well, you have to determine what style you are. If you're the value add kind of guy, like Jack is describing, or you're a coupon clipper. You just buy something stabilized, just clip those coupons. There's nothing wrong with that either.
Yeah, and it's a similar sort of thing to multifamily, right? ABC class, you pay a premium for the better sort of product, but then there's some people like Jack who go after the C class assets and then make them nice, so that an A class person will pay them a premium for it. And so it really depends on your penchant and your comfortability with that risk. And so there's ways to mitigate it, like Ryan mentioned in the beginning. And then, there's also ways to screw yourself over, especially since on commercial deals, you take on a lot more risk that you don't have protections for, right? Let's, in multifamily, for example, or even residential side, you have like your standard fixed rate loans, and it's very easy to understand, right? You have 30-year fixed amortization rate, and you have a fixed interest rate that's not tied to some random market number. And so you're oftentimes at a much easier, time buying and selling residential, because it's just so much simpler. Whereas with commercial, Jason just mentioned too, there's an eviction moratorium for commercial, which just recently ended. So oftentimes there's usually less protections on the commercial side for the tenant, but everything is worked out through that lease. I think, let me see. There's a lot of risks involved in both, but how do you guys usually mitigate risk, and how do you feel about that risk compared to multifamily from what you've done in the past? Jack? You're muted.
Wait, sorry, what was that?
How do you feel in terms of risk between residential versus commercial for you?
Commercial is a lot riskier. The exit strategy for residential, there's a bigger pool buyers for residential. It's much easier to sell. Commercial is much tougher, and lending is tougher. So So I'm a commercial guy, but it's not for everybody. But if you don't want to deal with a lot of the headaches, with tenants and stuff like that, I always recommend commercial. Especially what I went through one of my properties when I first started investing in real estate. Yeah. Oh my God. Yeah. I still think till this day, I'm like, what the hell just happened? So then, that is another story.
There's a lot lower likelihood you'll run into crackheads in the commercial, I feel like. So that's the perks. That's you got any other last tips before we close off on this, Jason, in terms of the risk between the two?
Risk, I think ultimately it's still coming down to how you vet your tenants. Like, and again, that lease, you need to know it inside and out. That's what I was referring to in terms of the brain damage. Like, instead of fixing the toilets and calling repairs because it's triple net, like there are times where it just comes up and goes. For example, we have a tenant they gave me a call. I said, hey, the roof is leaking. I go, well, I don't think I'm supposed to fix it. And like they go, well, I think you're supposed to fix it. So I read the lease and I just took a screenshot and go, no, you're wrong. Go fix it yourself. So you have to be very familiar with the lease, and it's, I think, similar concept or idea in residential too. Sometimes it's worth it to be vacant an extra month to get a better tenant in there. That's one of the easier ways to reduce your risk.
Got it. All right. Thanks again for that, Jason and Jack. I think that's it for our time. We're gonna call it here. It's 7:55, 56. Do we have any updates, Annie, to follow up with for everyone?
Yeah, so this is, again, we mentioned this is the beginning of our commercial real estate series. We're really excited to learn something new for the crowds that are just getting done with those tenants from hell stories and moving on to something new. Just a quick reminder to folks that are in California, we have monthly meetups over in SoCal, led by Jason, and then also NorCal by me. So hopefully I'll see you guys in September, and keep checking our events calendar for new things that are coming up. So thanks, guys.
And Texas trip, again, we have official dates. It's beginning of November. And so 2 months is the best time to buy flight tickets. We're going to be doing Airbnbs. We're going to be sharing some rooms with people. So please reach out and let us know if you're coming as soon as possible so we can plan that out ahead of time. We're going to be looking and chatting with at least 2 brokers per city, and driving around trying to figure out where the best places to buy are. We're going to be hitting the shooting ranges with the Cito brothers. I don't know how we include that. We're also going to be trying out a lot of the Asian food out in Austin, not Austin, for sure not Austin. Barbecue in Austin, Asian food in Houston. So while it is going to be fun, we're going to try to focus a little more on real estate this time instead of partying as much as we did in North Carolina. All right. Well, that's it for our time. Thank you everyone for coming. Let me know if you have any other questions, and I'll follow up with you, Jason, about how to invest if you're not an accredited investor in commercial real estate. All right. Thank you, everyone. Have a good time. All right. Bye.